Hey, traders, welcome to the Top Tier Outlook. Hope everyone is having a great evening. We've had our time shift, and it is unusually dark out right now because it's really 7 o'clock, but it's 6 o'clock Eastern, and welcome to our shift time. I forget, is this the real time or was it the real time before? Regardless, the shifting stuff has to end, but nonetheless, glad to have you here, 6:01 p.m. Eastern, and we are taking a look at the open, what should be a very interesting week, but not necessarily because of the reason that we think it is. It's not the Tuesday election and the Wednesday reaction to the election. It's really Thursday's FOMC. That is the most important event that we have coming up this week because not only are we scheduled to get a quarter point cut, that is the discounting, that is the highest probability expectation we have based on the data. And that is going to happen. So that when we say something is discounted, something is baked in, that means the expectations are priced into currencies, bonds, equities, etc. Right? It's the most likely outcome. The real fireworks are going to be the rate statement itself and Powell's comments. There was an interesting thing that happened on Friday with that miss in non-farm payroll. And most of that was very much a weather-affected miss. And broader averages really didn't react all that badly to it. They climbed up a little bit, but considering it was, 100,000 miss, it really wasn't that dramatic a reaction. Likely because it was discounted. It was expected that the weather rolling through the Southeast, those two nasty storms, really disrupted a lot of the employment picture for this part of the country. Okay, so it was weather affected. We knew this was an outcome that we could be dealing with. All right, so then the next thing is, if we're expecting the rate cut, well, what about December? What about January? And that's where the words of the rate statement and the press conference are going to make the biggest impact. Are we seeing that Jerome Powell is sounding dovish, is preparing the traders and investors listening to him for another rate cut in December, which, by the way, is also expected? You might say, okay, Rog, this expectation thing you're talking about, how do we know this? Right? I'm going to show you right now how we can determine these things. And it's with a pretty simple website called the CME FedWatch. And this is it right here. And if we head on down to, let's go over here. So this is the November expectations of 95% plus priced in. That's what I mean about the expectation. And then if you take a look at December, now right now we're at 4 3/4 to 5%. That's where we are right now. On the 7th, this Thursday, we're going to be down to 4.5 to 4 3/4, so 1 quarter point less. Going into the December 18 meeting, the last meeting for 2024, it's 85.5% expectation that we'll see another quarter point. Now, this is what the Fed fund futures are pricing in. If there's a reason to change that, it'll be because of data or the things that Jerome Powell says. There's a 14% chance on December 18 that the Federal Reserve holds instead of cuts 25 basis points. So this is what we're expecting. And the more that we have to make adjustments to this expectation, the more volatility we'll see. If we're not expecting as many cuts, let's say we're behind the curve, right, on the rate cut, and the Federal Reserve is far more dovish than what's priced in here, then we'll have to correct that. If we're too dovish and the Federal Reserve is communicating that they could be open to a hold, then once again, we'll have to correct that. So keep in mind that a lot of the expectations around where the broader averages are going is not the election, gang. It's what Jerome Powell comments, the press conference, and the Fed rate statement is. So this morning, or this morning, actually, the Asian session, but what do we have going on here is the first look on the new day. Not that this is necessarily what's going to happen, but it's interesting to see that we don't have any kind of significant gap. I'll say not significant because, sure, we're opening below the previous session close of Friday. So there is that line in the sand there, but we're still trading above the lows from Thursday. We're still trading above the lows from Friday. And right now, Obviously it's a very fresh candle, but nothing jarring, nothing new. One of the best things we can ask ourselves is this new? Is this price action going to a high that we haven't seen in a while? Is this going down to a low we haven't seen in a while? Is there something new? There's nothing new about what we're seeing right now on the S&P Dow or NASDAQ. We're really in the range of the previous sessions. So again, nothing new. And it would make sense that we would kind of see some sideways action, because whatever we think is going to happen, yeah, there might be some last minute Monday, Tuesday discounting about the election. But for the most part, whatever it is that traders and investors and hedge fund managers and whomever have been expecting going into the election, chances are the bulk of those positions, whether that be long financials or whether that be short energy or whether that be long solar or clean energy, all sectors that have been moving, whether that is any one of those four sectors, it's likely already a position that's open. And now we're waiting for whatever the outcome may be. It's not unlike earnings. The best way to look at the election is the way we look at earnings. We know it's an event that's coming. There's a huge ramp up to it. And then traders place their bets, so to speak, based on what they think the outcome will be. And then whatever the outcome is, then there's a sudden correction of that. For example, if we think a particular company, our analysis says that it could beat revenue, it could beat earnings, we put on a long position. If that position is wrong because they did not beat, maybe they just only met expectations, maybe they missed, then there's that sudden reaction to the fact that what we thought was going to happen didn't happen. That's where the chaos, that's where the volatility around any event that we know is coming, that's why it happens. So right now, nothing really to make any big changes around. Bonds, I've been getting a lot of questions about bonds. So here's the answer with bonds, gang. Bonds typically front run the market by 3 to 6 months. What does that mean? Right now, what bonds are reflecting have nothing to do with November 3. They probably have more to do with, say, February 3 months from now. So the same thing would occur if we were looking at the uptrend in July, right? So think about it this way. If we started bottoming out in June, July, what was 3 months later? So June, July, completing August, boom, September. So June and July, bonds were saying we're probably going to get a cut in September, which means lower rates. And the rates actually, and this is where you can really see it. If you're wondering, Rag, I don't get what you mean by they're ahead or front running. I don't mean front run in any insidious way. What I mean is they're not now. They're not here. They're 3 months from today. That's why I say they're out in the first week of February. Just like the June expectations as the bond market was climbing higher, right? Which means yields are going lower. This was getting ahead of a narrative that was a September rate cut. So why, after we get a rate cut in September and we're expecting a rate cut in November and we're expecting a rate cut in December, why on earth are yields, as bonds move lower, why are yields moving higher? What is going on? What's going on is there's a lack of confidence about what we could see come March. Right? So if by December, we're going to be down at 4.25 to 4.5. And in January, do you see there? The 4.25 to 4.5 is 52% expectation. We only have about a 40% expectation of another cut. So when we go into 2025, the conversation about are we going to see one rate cut after another, that's not as certain. And if anything, it looks like we might see a hold. Hence, there's no reason for higher yields. And then that's one narrative. Bonds are like a layer cake. That's one layer. Consider that the icing, right? What's another layer? Concern about a post-election environment. What's another concern? Whatever the economy might be doing. What's another concern? So bonds are going to be factoring lots of concerns, and that's what they're factoring in now. Everything else is factored already in. So don't look at bonds, because I hear this all the time. Bonds are saying something. Yeah, they're saying something about 3 months from now, right? So if you're looking at this saying, well, the indices should be down, the correlation that a lot of traders think bonds have to the indices is not a now correlation. Again, it's 3 months from now. So it's absolutely bananas and uncorrelated to say because bond yields are moving higher, the equities have to fall. And this is what I'm going to show you because we do a lot of data discussions. We do a lot of price discussions in the mastery. We don't just throw ideas out there and just say, this is what's happening. Here's the proof. And anyone who's saying right now bonds are saying something, there's no proof behind it. Here's why. I'll show you. And be careful about listening to stuff like that. Bonds have been moving lower pretty convincingly since the 25th of September. That's the first time I got a red candle, which is a bearish candle, bearish movement, and bearish participation. So let's draw a line at the 25th on bonds. What was the S&P doing on the 25th? Here's the 25th. Right there. Weren't they punching up to new highs and then pulled back and punched up to another new high and another new high and another new high? Right. So bonds moving lower, and by the way, bonds kept moving lower after the 25th. The S&P kept moving higher because they're not in sync. Be careful thinking that today's bond movement has anything at all. Now, every now and then, like a broken clock, they'll be in the same spot. It'll be right, but it's not. Again, go back to when bonds started moving to higher yields, and you'll see we punched up to 3 different all-time highs on the S&P, and the NASDAQ is no different. A lot of times I find myself in this stage of my career kind of feeling like those awesome folks from that show, Mythbusters, right? Who used to watch that show? I love that show because things that we want to believe are true, if we have the confidence to question them, we're going to have then the ability to be better at what we do. I think a lot of times traders opt for what's easy, not effective. It's easy to compartmentalize. It's easy to say things like bonds always lead indices, or the Russell leads the broader averages, or whatever unproven, no data behind them sentences, phrases that people like to say, right? We love to compartmentalize. Makes us feel like the thing is easy. The truth of the matter is both those things are wrong. We're looking for effective. So be very careful wandering into, well, this is a leading index or this is a leading indicator. I wish those things were true, right? It isn't, but we can look at things effectively. So if we let go of this notion that trading is easy, and I get from every now and then, I get emails in my inbox too from all sorts of folks because whatever list I've landed on over the course of opting in to who knows what over 20 years. And I'll get this whole thing about, how easy trading is. And I'm thinking to myself, trading itself is actually not terribly difficult. But it doesn't mean that I'm setting and forgetting it and I'm going off and riding in my yacht while I go to sleep and wake up to, the confetti falling out of my ceiling and all these other things that traders, sadly, retail traders think trading is. What trading really is we are going up against well-funded, disciplined, informed, full-time people, right? They aren't looking to set it and forget it and go have a picnic, right? They're at this. That's who we're up against. That's who's trying to take our money. I'm not saying we need to be obsessed and not sleep, but I am saying we have to go about this with an edge and with discipline, right? So the notion that we're just going to have this easy run and, this is going to tell me everything, I wish that were true. I spent time looking for that some part of my career. And then I just realized it's just testing things over the course of at least a year, if not a year and a half, as most of my indicators are tested for that long. Most of my strategies are tested for that long, not back tested. That's not helpful. Forward tested. Here's an idea. Here are the rules. And let's go put on a year's worth of trades, seeing if we can disprove that hypothesis or break that indicator. And then maybe I have an edge. And then I go about using the discipline of position sizing, discipline of stop losses, the discipline of watch list building to go against some of the most well-funded, brightest minds on the planet. That's the reality, right? So let's stop optimizing for easy and for going and having a picnic, saying, look, what is effective and can a retail trader gain an edge? And I do believe that's true. right? A retail trader can gain an edge. We have we have a unique advantage to being small and nimble, like a ninja, right? We're not moving armies of money around like a lot of these hedge funds and larger traders have to. There's a burden to that. I know you might say, Rog, I love that burden, but it is difficult when you've got to move a lot of money around. It's tough to do. But when you're a smaller retail trader, again, even even a seven-figure contract is small in this world of trading that we're in, right? There is a lot of advantage to being a retail trader and having a smaller-ish account. And I do believe these things to be true. We just have to quit pretending like we're a hedge fund, quit pretending like, we're something we're not, and use the advantages that we do have. I think about this a lot because on the weekends I read emails, and I read emails from folks who are sometimes kind of frustrated that they haven't had a good year. And I'm thinking, gosh, I've just got to work harder about getting the message out that when the trend is on, right, we buy the dip. And when the trend is off, we go find where the trend is, right? And then rinse and repeat. Find the trend, buy the dip, find the trend, buy the dip. If there's no trend, there's nothing to do. And that's the discipline, right? That's the discipline of what we're trading. And these are things, if you just continue to work on that edge over the course of dozens of trades, maybe 100 trades plus, you'll find you come out the victor. Not home run hitting, not how did I do at that one at bat, but how did I do for the month of October, right? So those are things that hopefully, as we're winding down this year, this has been a really good year for account growth because most of the year has been moving higher in some way. I mean, all-time highs, gang. That's the kind of market we're trading right now. It's not the 2020 market, but we do have lots of pockets of really great trends. I mean, I take a look at the way we've been trading gold in the Sector Secrets Mastery. That's a gorgeous trend. Find the trend, buy the dip, rinse and repeat, right? All right. So question here, Magnitude asks, how does a 6E factor into a conversation like this? So 6E is a really cool way of looking at the euro versus US dollar. I've been trading Forex for a very long time. And I would look at the 6E in the same way that I would look at the euro versus US dollar, the spot foreign exchange. And that is the euro versus the US dollar, where the euro is the base currency, which means that it's directionally sympathetic, directionally in line with the euro's strength or weakness against the US dollar. And the 6E is the same thing. This is also the best way to look at the US dollar, by the way. If you look at the US dollar, it's a basket. It's a basket against 6 other currencies. 58%, I believe, of the weighting is euro. So euro and US dollar have a high 90s and steady correlation. Euro goes up, US dollar goes down, and it's almost that immediate. So how does the euro factor in? The US dollar has been kind of weak, as we would expect it would be, because when any central bank starts to lower rates, the country of that central bank starts to see the currency depreciate, right? So I'll say that again. If the Federal Open Market Committee, the FOMC, is cutting rates, it naturally, this is not some sort of accident or, oh my gosh, as a byproduct of lower rates, the currency loses strength. That's normal. It's nothing bad. Same thing goes for any other central bank that's cutting rates. By the way, when you hike rates, when you raise rates, it strengthens the currency. But the question is that currency strengthening against all currencies equal? Of course not, right? So the US dollar is losing ground against the euro. But is it losing ground against the Canadian dollar? It sure is. Is it losing ground against the British pound? I take a peek. It is a little bit. Is it losing ground against the yen? Once again, it is. So we have to look at it on a relationship by relationship basis. We have to look at the US dollar versus each currency. The best way to do that is these currency pairs, either on the CME, the futures, or on the spot. So how would the euro factor in? It just depends on whether you're looking to play, what's the driver of the idea? This is another thing I used to teach when I was trading Forex and teaching Forex. What is the driver of your idea in the currency? Is it to take advantage of euro strength, or is it to take advantage of euro weakness? Because once you understand the driver, the main idea of that currency pair trade, then if I'm looking for euro strength, I would try to find the weakest currency to trade it against. It may not be the US dollar. It might be the yen. It might be the pound. It might be the franc. It might be the loonie. It might be the Aussie, whatever it may be. Now, if we're trading only the majors, which are currencies against the US dollar, that's going to be pretty finite a list, as opposed to if we were trading the foreign exchange, where we really have liquid access to all sorts of currency combinations. But, understanding the driver of the trade allows us in the Forex world to find, if I want to be a euro buyer, the weakest currency to buy the euro against, which is what keeps that trend going. So that's the way I look at currencies. It's always what versus what. And we always want to contrast a strength currency versus a weakness currency whenever we can. And then the second tier would be finding a strength currency against, say, a flat currency, right? At least it's got a better chance of losing ground or gaining ground against a flat currency. But if we can get contrast, strength on one side, weakness on the other, that's when you have those amazing currency trends. All right. What's a good entry for Bitcoin? Sure. So if I'm looking for a pullback, sure. Thank you for the question, Kay. If I'm looking for a pullback on BTC, I've got a ways to go. I would focus on a mean reversion. Now, remember, the frenzy around Bitcoin was pretty intense going into that 73,000 level. I would start looking around 66, maybe 9, and then really wherever the daily price movement range would be. But give it a moment to settle down, because it definitely, as you saw through the jump through 70 and the jump through 73, which was specifically October 28 and 29, we're seeing a little bit of weakness come in. I would let that simmer down a moment. But that's where I would look at. Now, I want to make sure, okay, I have not been trading Bitcoin. The moment it starts getting the headlines, the moment it starts getting the frenzy about new highs again, it's really difficult to trade, because now it's just sort of transcended volume and volatility and technicals, and it's sort of on its own psychological frenzied journey. So I'll wait for things to settle down. For me, a mean reversion would be a good place, to look. Okay. All right, gang, as always, thank you so much for being here for the Top Tier Outlook. We do this every Sunday at 6 p.m. I'll be back with you tomorrow at 9 a.m. as we have for 3+ years for Charts and Coffee, 9 a.m. Eastern to 9:20 Eastern, Monday through Friday. Enjoy the rest of your day. And I'm going to go watch the Brazil F1 replay and see how that went. No spoilers. I hope everyone's having a great Sunday. I'll see you all tomorrow. Shan't be a boring week. All right. Be good to each other.